Hey guys, it's Willie. Today I want to talk about Disney. You're looking at 102.42 as the current price. Here's your year-to-date chart, dropping from 156.76 down to 102.42. That's about minus 35% over since the beginning of the year-to-date. Disney's a wonderful company. You know, they've got the name, the brand, the moat, whatever you want to call it. But the stock price has been pummeled. So I think this is a really good company to look into. You know, we're looking for those really solid established names, established companies that are being hit with a price decline in the stock for no obvious reason. So we want to always take a look at the financials to make sure that this is unjustified. Because if you see a fall like this and it's justified, well then don't buy it. You know, we're not going to get into a stock where a fall is justified. We want to find financials that don't justify this fall and we can pick up a cheap stock. So looking at those, we switch over to our spreadsheet. As always, we look at our revenue, net income, and free cash flow over the past 10 years. Revenue, good for Disney. They're growing a little bit. I expect that out of Disney. They're a huge company, but they should still be able to grow at least a little bit. Net income and free cash flow, I can't say the same. They've had a rocky couple, few years right in here with free cash flow and net income. It's just really wonky. It might be a COVID thing. That would be my guess there. I don't know, but I still don't know what this jump is for. That's something to look into. So not liking the trend with the net income, free cash flow. I'm also not liking the trend with the shares. I was liking this trend, but that stopped in 2018 when they started issuing more shares, which I don't like. Yeah, I don't like it. So, you know, when these numbers are all things I don't like, the per share numbers are not going to be things I like. Earnings per share and free cash flow per share are in a decline. You know, I don't like any of this from Disney so far. A bright spot in all of this is their assets. I mean, okay, they increased their assets. I think the only thing I can think of would be the Fox acquisition that Disney had. Just bumping those assets up. Don't entirely know. That might be where some of the issuance of shares that's come from. I don't know. You've got your dividends here. Disney made a smart choice, I think, on their part, where they cut their dividend down to 0. They said, guys, we've got falling net income, we've got falling free cash flow, we cannot afford a dividend anymore, so we're going to stop. I think Disney made the correct choice there, and they did what they were supposed to do. Debt, cash, net debt, total debt is up a lot. As you can see, they align with the asset jump here. Again, I think that was the Fox acquisition. I may be mistaken on that one. Always double check. Cash jumped here for some reason. I don't know why. Net debt, that's up. Again, lining up with what I think is this acquisition in here. I don't like the debt. If you go back and look at an older time frame comparative to free cash flow, the debt was manageable. Compared to free cash flow now, it's not. It's just ridiculous that free cash flow and net debt are at a ratio like this. And then ROIC has gotten really, really bad. Right in here. It's just terrible over the past few years. Yeah, I mean, Disney's had a rough few years. Right in here, it's just terrible. I don't know what's going on. I don't know sort of the direction of the company. This is why I'm struggling a bit to look at Disney right now and kind of think of the path forward. simply because they've had such rough years. I think they'll recover. I don't know how long that's going to take, and I don't know what that's going to look like, and I don't know what kind of growth they're going to see from here. I don't know. I really don't know. Yeah, so with that said, looking at our metrics, none of them are going to make any sense because, again, the most recent year has been really, really bad. So our long-term growth numbers that are focused on, the 2012 number and the 2021 number, it's thrown off because it's focused on the 2021 number, which makes it funky. And so it looks super expensive. Debt's too high. Revenue growth is actually positive. Surprise. Earnings, free cash flow, negative. Shares outstanding are up, bad. And then ROIC is 7.8%. Not great. Yeah. So the problem with Disney is just these few years in here. So when we come down to our forecast and I say 3% with a 15 multiple, both with free cash flow and net income, you're getting about $22 per share. Again, average those two together, you're getting about $22 a share. Well, it's trading at 102. Oh, wait a minute. That means that the ROIC is looking at not ROIC, IRR. The rate of return is looking at minus 13% a year. And then you say, well, wait a minute. This doesn't make any sense. What the heck are you talking about? And that's immediately my thought is, why the heck would Disney be trading at such an expensive multiple, I guess? Just why are they so expensive? What's going on? I think the problem here is we're focusing on these end numbers that are abnormal. You're focusing on these abnormal numbers. I think you need to focus on something more like an average year. Say, these numbers here. I think that looks roughly, roughly normal. Things were normal, and then things started getting funky after that. So let me illustrate by using those numbers, and let's just say that the most recent numbers were those numbers. Okay, they weren't, but let's say that they were. This is just like our long-term average. So we're now looking at growth over long term. Your free cash flow forecast is looking a lot better. Your net income forecast is looking a lot better. Your prices are looking a lot better at 96 and 99. Average of those is 97.6. Current price is 102.42. You're looking at an IRR of 6%. Okay. Alright. Starting to make more sense. So I think that is where things start to fall apart. And then, depending on how much you think Disney's going to grow from here, that is where things get interesting. I mean, if you think, okay, let's go back. So let's say they're going to end up at 641 in 10 years. All right. So they'll get back to normal and they'll keep growing and they'll end up where they were going to end up anyway. So that's looking at, what kind of growth rate? About 20%. Okay, 20% a year gets us to roughly that number that we were looking at before. $100, 101 price target, 102 right now. All right. You're looking at only 3%. Okay, do you think that's what's going to happen? I don't know. I really don't know. I don't feel comfortable jumping into Disney right now because I simply don't know. I simply can't ascertain what it is that's going to happen to this company. I don't think we're going to see this situation. This doesn't make any sense. I don't see you getting a minus 13% return. But I don't know that you're going to beat the market with it either. I think that sort of 3 or 6% with those other numbers make more sense. I think those numbers make more sense. I think would probably be what you'd be looking at realistically. However, that's not what we're looking for, is it? We're looking for plus 10% beat the market over the long term sort of plays. And the debt. I really can't stand the debt. The debt is way too freaking high. Like, I'm sorry, but the debt is way too freaking high. Even for a company as solid as Disney. Which apparently isn't that solid given the past few years. Yeah. So, beyond that, I don't have much else to say on Disney. I expected this to be a much more interesting video. Sorry, it's really not. But we'll keep looking. We'll find something eventually that looks good. So, beyond that, I don't have much else to say on this stock. Comment stocks you want to see. I will try to get to them as best I can. And if they'll make an interesting video, I'll do a video on them. But yeah, anyway, I'm done with this one. I will catch you guys in the next one.